What's up everyone? Today we want to talk about 3 ways on how you can get high return on your money. Let's go. Welcome back to my channel where we talk all things personal finance and early retirement. If you haven't done so already, please subscribe and like this channel for the algorithm gods. The question is, how do you manage your risk and at the same time try to get as much reward as possible during this crazy bull run of BTC and alts? There's absolutely no answer for everyone. Everyone's at a different part of their life. You're building your wealth or you're securing your wealth. I think those are the 2 main factors that you should calculate into your portfolio allocation, not only in crypto, but your overall portfolio against, index funds, stocks, retirement plans, pensions, if you got it, cash in the bank, real estate, collectibles, whatever you got inside your investment portfolio. Measure that against, your risk tolerance, where you're at in your life. You're building wealth, you could possibly be a little bit wealthier if you're not touching it for 10, 20 years. If you're close to retirement, you got to retire in the next 5 to 10 years, you might want to play a little bit safer. And if crypto grew to a big size, you might want to reallocate to a smaller portion of your portfolio. Meet Kevin, and Kevin O'Leary did a really amazing interview the other day. Kevin O'Leary is just in wealth protection mode. He cares only about 6% growth. That's it. That's all he wants in returns for him and his clients. So he's risk adverse because he's protecting his wealth. He doesn't carry any more than 5% of any stock allocation in his portfolio. And he has over, I think he said 900, was it 300 or 900 stocks? It was in the hundreds of stocks. But in every single stock, he only has 5%. Anytime he goes over, he reallocates and redistributes his wealth back into whatever new investments there are. So that's his strategy. But the question is, what is yours and what is mine? We're in wealth accumulation stage, baby. Pedal to the metal, gas all the way through, put in the nitro, put in the fast and furious turbo boost while we're at it. That means no reallocation here. We're only dumping more fuel to the fire. Let's go. If you're part of the FIRE community, you're all about getting return on your money, whether it be bonds, 3 to 4%, or equities, total stock market index, which averages about 7 to 10%. You're looking for consistent gains. What's happened though in the crypto world is that has flipped the yield upside down just for holding stablecoin, which is a USDC or a USD, or I'm sorry, GUSD. Gemini went the other way. They wanted to be different. Or GUSD, you can get up to 8.5% on your money just for holding cash. Well, it's not really cash. It's the stablecoin equivalent, but that is a cash in terms of crypto. In fact, many countries right now are looking to create their own stablecoin and trying to peg their currency against that and for everyone to utilize. Let's choose Ireland, for example. Many American companies there. What if you lived in Ireland, but there was an option to get paid in USDC, or let's just make it up, USDA, which America creates as the USD stablecoin by the government, and they allow international payment in that way. What would you like to get paid in USDA, which means that the USD, which is pegged to the dollar, supposedly never going to fluctuate, it tracks the dollar, versus Ireland currency. And that's all due to personal preference. You could value one currency more than another. It doesn't have to be USDA. It could be whatever China's creating, for example, or Australia. Maybe you believe in that currency more. You're from there. Your family's from there. There could be so many reasons. Let's say you travel a lot. Let's say you have a business that you spend a half year in one place, a half year in another. And is it possible one day, what if you chose to get paid in 2 or 3 different types of digital currencies? That would be absolutely crazy. And I could probably see that happening. We're totally off track, but a lot of governments are already doing this. They're looking to create their own stablecoin, and the use cases are just unimaginable. What I'm trying to say is stablecoins should be secure, backed by the USA, hopefully one day, or backed by an institution like Coinbase and Gemini, where they have insurance, and that your dollar is safe in that USD or GUSD stablecoin. Step number 1 is holding your crypto assets into an exchange like BlockFi, Gemini, or some DeFi exchanges. We'll go over BlockFi because it's the simplest to understand. Just for depositing Bitcoin, they give you 6% APY. GUSD, which is just a stable coin, 1-to-1 on your dollar, they give 8.6%. That's a lot. Ethereum, 5.25%, and USDC, another stablecoin, 8.6% as well. That's high. FIRE member strategy is investing into the total stock market index, which returns on average a 7% a year return. Now you can do that by just holding stablecoin into an exchange. That's absolutely insane. There's no downside risk here unless, these exchanges blow up. Let's pretend we live in a perfect world and that this APY stays forever, and also the stable coins are secure, they're not going to go anywhere, and it's pegged 1-to-1, and that BlockFi, Gemini actually has the finances that back this stablecoin in case people want to withdraw all their money. If all that holds true, then the strategy of holding stablecoin as an investment is actually better than the total stock market index. Yes, the S&P and total stock market index did return a whopping 40+% last year. However, we're talking about the average of 10 years. Most f.I.r.e members want to play it very, very safe, and that's why they do total stock market index. If you could invest into an asset that gives you 8.6% year on year for 10 years straight with no risk, remember, perfect world, this is better than investing in stocks. Is that going to happen? Probably not. This APY is probably going to get lower, competition is going to get in, and the APY is probably going to get a little bit lower throughout the years. Number 2, similar to investing into centralized exchanges, you can go into decentralized exchanges called DeFi. Head over to DeFi.com and it'll show you the rates that you get for holding stablecoin on the different types of DeFi exchanges. As you can see here, DAI is another stablecoin. You can get up to 12%. And here, USDC, you can get up to 12% as well on the exchange DYDX. Never heard of it before. I've heard of Compound though. Of course, this all fluctuates. I've seen it go from 5% all the way up to 12%. The annual yield will probably be a little bit different than what you see here. That's just what it is at this snapshot in time. It's a little bit more complex, and you do need some ETH to submit your actions within these DeFi, so it will cost you money to make you some money. But if you want to play in a safer space and technicality is not too hard for you, then get into some DeFi. The next strategy you can utilize to get yield on your money is going back to centralized exchanges and lending out your stablecoins. There's no volatility here, however, the risk is with the exchange itself and the borrowers. Everything's calculated and collateralized with margin calls, however, there's still risk that some borrowers will default. If you can stomach that risk, then lending's for you. In the traditional world, if you do this through Robinhood or Fidelity, that would be the institution or the people behind the scenes that are, lending money to them. So crypto is really narrowing the gap for the big players and small players to come in and play a little bit as well. If you take a look here, the average daily rate is 0.263%, which means the annualized rate is 95%. Don't let that trick you though, because they can settle at any time, 1 day, 2 days, 3 days, 4 days. The annualized rate changes every single day because the interest rate changes every single day. I don't know what the annual return is for this exchange. I'm going to test out $1,000 for a month and let you know how that goes. If you take a look here, I've lended out a various amount of USDT, which is a stable coin. I lent it out for different amounts of rates, different amounts of days, and different settlement dates. So far, I've made 28 bucks, looking pretty good. I'll let you know how it goes later on. In this strategy, you're lending money to traders who are using margin to leverage the trades. If they make money, you make money, everyone wins. If they lose money, they get margin called. You should still win. However, if there's a black swan event where everyone loses their money, then maybe you won't get your money back. It probably won't happen. If it does happen, the exchange has insurance that will cover a lot of lenders. They don't want to upset the user base where they get all their golden eggs from. They're probably going to take care of them. However, you never know. It's an unregulated space. Lend at your own risk. Lastly, there is staking. Staking is a little bit different than lending. If you leave your money on exchange like BlockFi or Gemini, unknowingly you're lending your money out, similar to what we showed you in KuCoin, lending to margin traders. In staking, you're not lending out money to margin traders. You're staking a coin so it keeps the network secure, meaning that there's not too much movement of coins entering in and out of exchanges. You're just utilizing it there to keep the exchange network safe. No margin calls here, no borrowers here. So just for holding a coin in a node per se, through an exchange, you will get 3 to 7% on TRX, 3 to 5% on Luna, Polkadot, 5 to 14%. It depends on the miners, the rates, everything that's happening in terms of transactions for that day, that month. Personally, I haven't tried staking yet, but I will try it for you guys so that we can document it to see which strategy works the best. Coinbase has already opened up a wait list for if you want to stake Ethereum. Hold on to your horses here because you need 32 Ethereums to stake. Right now, that's about $64,000. You can get 3 to 7.5% back on Ethereum. If Ethereum 10x's from there, you would have made a great investment. If it drops 50%, then maybe you shouldn't have staked. Staking is different for everyone because certain tokens require you to lock it up for a minimum amount of time and then they have maximum amount of time. So really, you're going to be illiquid for a set amount of time. And if that's a risk you want to take and you can't get out of the market, then that's something you have to assess for yourself. In today's world, you have to find an edge. You always have to look at what's changing to get better yield or better return on your money. Things are changing all the time. In the crypto world, you blink and it changes. It's that crazy right now. It's that quick. But blockchain is here to stay, so if you don't have a Bitcoin strategy or crypto strategy, you best get one immediately. Those are the 3 steps on how to get high APY on your money. Let me know if you have some strategies down below. Let me know what other videos you want to see in the crypto space. Follow along as me and the wifey head to early retirement. We're on year 2 out of 10, 8 more to go. Let's get it together, guys. We're gonna have a lot of fun videos coming your way, so make sure to tag along. I'll catch you guys on the next one. Peace.